South Africa's trade deficit widened to 13.8 billion rand in September after 12.2 billion rand shortfall in August as mining exports fell. Now this comes after unsecured loans surged by 21%. That's to 381 billion rand in the year to June. For more on this, as I said, we're joined by Tami Sakutu, Chief Risk Officer at African Bank. It's great to have you with us. So you've heard what my two guest hosts have to say about the unsecured loan space in South Africa. It's up 21%. It's on everyone's lips right now. I suppose the first question to say, is there a bubble forming? And if there isn't a bubble forming, why would you argue that it's not?
Well, we have struggled to find a definition of a bubble. So I'm not sure that I can commit myself to say that there is a bubble forming. What we have said in August, when we issued a statement to investors and analysts, we said that we are concerned about the rapid rate of increase in unsecured lending specifically in a relatively short space of time. And we said that because of that rate of growth, which is very specific, we are concerned that there will be certain segments that are under pressure from a risk point of view. And therefore, we're taking steps to pull back deliberately in order to manage the risk. And that's what we did. And today, we are seeing some segments in the unsecured space that are under pressure as we speak.
Tommy, the National Credit Act was put in place to ensure that you didn't have bubbles like these being created. Are you saying that there are certain parts of the Credit Act that's not being effected properly?
Well, in fact, if we didn't have National Credit Act, we probably would be in a worse situation than we are today. The National Credit Act has done a lot to ensure that there's a lot more responsible lending across the credit industry in South Africa. I am not saying that there is a bubble. I'm saying that there is a concern about certain areas of the market being under pressure, and therefore having certain categories of the segments being under pressure, and we need to do something to quell that. Fortunately, as a result of the kind of hype and everybody commenting on unsecured credit, etc., we have seen some of the reputable players in the space pulling back, and I think that we're going to relatively soon we're going to see some slowdown of the growth, which, in my view, would argue against an argument that says going forward there is going to be a bubble unless things change.
From Abel's perspective, talk to us about your process when it comes to managing bad loans and writing off bad loans, because as far as I know, it's after 2 months. So talk to us about that and whether you're refining this further.
Well, let's talk about managing loans in general, not just bad loans. Abel African Bank is a pioneering player in South Africa. We still have the largest exposure of unsecured lending in the total unsecured lending book in South Africa. And this has come about because of the evolution of our segmentation, which has become more and more refined over time. So now, when about 6 years ago, we probably had 2 pricing points. Now we have more than 18 pricing points, which means we're getting closer and closer to pricing to the risk profile of the individual. We've gone a long way from stratifying our segments. That is why we are able to pull back lending to a particular segment if we see risk emerging in that segment.
Walk us through the process, because you've talked about having early warning flags when you've got customers that are defaulting, or sure. Obviously that default would be a warning flag. But walk us through the process of how you identify those customers that would fall into the high risk bracket.
Okay, according to the segments I was referring to, we are able to look there's a methodology that we use, which is called vintages. Basically, vintages, they tell us risk emergence in the different segments and also in the different businesses that have been written in different months. And we're able to track those vintages in a graph. And as soon as you see that the vintages are getting out of the targeted range, if you like, we're able to pull back from those segments.
I mean, what do you mean pull back? I mean, how?
Well, we're able to lend less than we would otherwise lend to them. For example, during this course of period, when we're saying that we've got a problem or we've got a concern around possible bubble, we saw that the higher income groups in our market, people who earn 15,000 and above, are categorized as high income group because we start from less than 3,000 to about 15,000 and above. We saw some risk emerging, and we therefore took a decision that we are going to drop our offer rates. So we're going to offer lower sizes of the loans and lower terms, and that enables you to manage the risk downwards.
What do you think of these kind of comments and how they're managing risk? And especially in light, I think, of the interesting trend where there has been a significant shift in the unsecured loans market to the more middle-income consumer.
Yeah, I do think that, of course, you can take measures like this with regards to specific individuals, etc. But what do you see, as I mentioned before, a possibility of like an economy-wide slowdown? I mean, what level of tolerance do you have in your model for that? I mean, that was the issue in 2008. People weren't assuming that the entire system would just come to the end like that. What is your predictions in terms of personal growth, and what implications will that have in terms of your risk profile?
Our business model is such that because we want to make sure that the business survives in the long term, we're able to switch off the tap on selling loans literally overnight, and we've done it before, where we switched off the top taps from 500 million rand a month to literally 150 million rand, because that's how you manage the risk. So we're able to do that. And in terms of the economy that we're experiencing now, unfortunately, the events around the world, the European economy, American economy, and some of the events within South Africa are such that we think that they're going to negatively impact on the economy. Now, our greatest risk as the business is if there's a total collapse in the economy, which is obviously an extreme situation. The reason I'm saying so is because we have exposure right across the sectors of the economy. So if one sector, let's say for example something happens in the manufacturing sector, we're able to isolate that sector and not lend in that sector. And again, we've done this before, so that we can continue growing in other areas which are safer from a risk point of view. But we are concerned because there is a structural shift, as you said, in unsecured lending. We're seeing people who are coming who were not coming to unsecured lending before, but that's also driven by the fact that secured lending itself is not growing. And therefore, that's why we argue that you can't look at unsecured lending in isolation from secured lending. Something has to happen somehow so that we look at it holistically in order to curb overall lending in the country.
But you don't think that shift from secured to unsecured lending is really driven by the fact that people are basically linked to the hilt in terms of securing their assets, and the only thing they can do now is look at their free cash flow and lend against that?
Absolutely. This we think that this is one of the drivers, that people are not getting any more credit from a secured point of view, and so they come to the unsecured point of view. Now, if you look at what are the drivers of this growth we're talking about, it's people who earn more than 15,000 and who take loans from about 30,000 to about 180,000 over a period of 3 to 5 years. And that's where the significant growth, if you look at numbers, came from. And I think it's important to clarify this because people, when you say unsecured lending, the mind immediately thinks that, oh, those are the low-income groups that are being affected. It is factually not correct.
And I know for another large bank also operating in this space, they've also said that it's the middle-income groups that are taking out these unsecured loans. When it comes to loan usage, just looking at your latest results, you talked about the fact that it's for home improvement, for how to buy houses, for education and debt settlements. And just looking at kind of graph there, in fact, it's been increasing in terms of the amount of loans that are going to people to settle other debt. That's worrying. And how do you manage that? How do you manage what people are using their loans for?
Well, one of the issues that we've pointed out to as our risk concern is actually the level of consolidation that's happening in the industry, in the unsecured lending. As competition has grown, again, it has grown rapidly, we have seen more and more consolidation, and this worries us. Now, you find yourself in a situation where you either watch and not be part of the party, or you become part of the party and be very responsible about what you're doing. So it's impossible to completely not play in the consolidation space because everybody else is playing in the consolidation space. But it is an area of concern, and I think we hopefully among us as banks, we are going to be able to address that. We've been having discussions around those issues. Hopefully, be able to address that.